And get started. Awesome. So I appreciate everybody coming to Transformational Tuesday. Hopefully, we'll get a few more folks joining. Some folks coming in now. So it is Tuesday, January the 13th. This is our first webinar of the year. So again, I really appreciate everybody coming in. Always, if you have any questions, please feel free to put them in the chat. I'll try to answer them during the time that we're talking, but sometimes I miss them because I'm letting people in, I'm managing the chat, doing all sorts of different things. So if someone can just give me a thumbs up that you can see my screen.
Yes.
Awesome, very good. All right, so tonight we're going to talk about passive investing and how busy professionals can build real estate wealth without becoming the landlord, right? So there's a lot to do with becoming a landlord. So again, this is a educational series. I am not your financial planner. I am not your financial advisor. I'm not your lawyer. I'm not your accountant. But I do try to provide what I believe to be true and accurate information. You must always do your own due diligence before doing any real estate investing. So again, I started passively investing back in 2018, and being part of a strong team and a mentorship program has made all the difference to me. So I so far have been a passive investor in 20 syndications and then a general partner sponsor, which we'll talk about the difference as we get going, in 16 in a total of 36 syndications. I love connecting with people, helping people learn, do different things. So I put my contact info in the chat. I'll put it again one more time. But if you'd like to connect one-on-one, please feel free to book a call. I'm always here to be able to answer questions. So a little bit about Massive Capital. We are very focused in assets in the Texas market, but we also have some assets in Georgia, North Carolina, and Denver, Colorado. We do partner with our company called Realty One. Realty One is more on the development of our retail side. So we've done two projects with Realty One. They have about 300 million in assets under management. I actually need to update this. I think we're about 218, 220 right now because we just closed two deals in December. So just so you know, we closed on December the 16th. We closed 60 apartments, 60 doors in Hope Mills, which is a suburb of Fayetteville, North Carolina. A very good opportunity. And we closed on 46 doors in Alvin, Texas, which is a suburb of Houston. And hopefully in February, I'm going to be having an educational property tour at that particular location. So we're now up to about 1,500 units under management. So we do retail and family office. We do triple net leasing through our retail locations, land development. So we have a couple of development deals coming up, steel frame construction. And then we do have our mastermind mentorship program called Massive Masters.
And now, here's someone you want to hear from, our sponsor.
For over 15 years, Skyline Title has been a trusted name in Texas real estate. From first-time homebuyers to seasoned investors, our team ensures a smooth, reliable closing experience every time. Backed by a decade of partnerships and proven success, we take pride in protecting your biggest investment, your home. Visit SkylineHTX.com to learn more.
So again, tonight we're going to talk a little bit about what is a syndication, GP and LP. We're going to just do a little summary of what happened in 25. I did a little bit on that in December, but I'd like to do a little more. Then, of course, we'll talk about real estate professionals building wealth, real estate the next cycle, top 3 reasons to invest in 26, and then always open for question and answers. And they can be on this topic or any topic. And if I don't know the answer, maybe it will become a future topic. So again, I've mostly focused on, well, only focused on syndications. So when I first started looking at doing real estate, I was terrified of toilets, tenants, and trash. I always thought I had to become a millionaire to become a real estate investor. Then I found out I didn't have to. I could invest in a syndication. So a syndication is a group of investors who pool money to buy and develop real estate. And syndications are a way for investors to invest in larger properties that they couldn't afford on their own. So again, how does a syndication work? Sponsors, general partners, they're experienced real estate professionals who organize the syndication, secure the funding, and implement the business plan. And then the passive investors are called limited partners or LPs, and they help fund the project and they own a portion of the asset. So a lot of times you hear people saying that you should use other people's money to buy real estate. And this is an example of what happens. Our passive investors are the other people's money. So let's say I'm going to buy a $10 million asset. So us as general partners, we're going to probably get about a $7 million loan, and we need to get the other 3 million. Now, in realistic terms, we're going to have to get more than 3 million, but I'm just trying to keep the example simple. So we're going to go buy a $10 million property. We're going to get a $7 million loan. And if you don't know what leverage is on a commercial real estate or any real estate, everybody should reread Rich Dad, Poor Dad if you haven't read it, but it talks about the power of leverage, right? The biggest lever to make real estate as successful is that you can borrow money to be able to do it. And then, so we're going to get a $7 million loan. So the general partners, they're going to get that loan. They're going to need to have the net worth of $7 million, about $700,000 in liquidity, and they're going to have the experience. So what happens is they don't just lend people money with money. You have to be able to say, I could operate these particular business, right? So they're not going to let us buy a couple hundred unit apartment complex if we'd have no idea we can operate it. So we would get a $7 million loan, and then we would raise $3 million from our passive investors. But here's where the real beauty is. So if you remember, I said we're going to use leverage to buy it, and then we're going to use other people's money, this LP money. But when you look at the deal, how we structure our deals, our passive investors actually own 70% of the asset, and we own 30% of the asset. So we take all of the risk of the big ticket items. Now, passive investors do take risks with their investment. You could lose a portion or all of your investment if everything went terrible. But again, I want you to understand the power of it, right? We're going to buy this $10 million asset. We're going to do all the work. We're going to buy the asset. We're going to manage the asset. And we're going to give the passive investors that invest with us 70%. So you actually own a piece of that particular real estate. It's a real asset. Very different than buying a stock or an annuity or even a REIT. A REIT, you really don't own the assets. And then you're going to share in the profits. And so make a dollar, 70 cents of that dollar gets sent to the passive investors, 30 cents of that dollar gets sent to us as general partners. And we normally even have it to where there's a 7% preferred payment where our passive investors make 7% before we even get to our split. So again, the benefits are limited liability, protects your personal assets beyond the investment. So again, I want to make sure I'm clear. Your investment is at risk if something terrible happens and the whole thing implodes. But if something else happens, if we get foreclosed on, if we have a big insurance claim, none of those things are your responsibility. Now, they may affect the business plan and the profits and the success, but none of them are your responsibility. You don't have to worry about them. It also allows you to target investment on specific projects. So you can invest in different types of asset classes, different geography, different vintages. So you can do value add apartments, class B apartments, class A apartments, new build apartments. You can buy existing storage, new storage, all different types of assets. So you can mix and match. And that gives you a little bit of diversification, right? I would never say to somebody, hey, if you're going to make 3 or 4 investments, invest in the same type of asset class in the same city. I would always recommend that you split them up and have a little bit of diversity. You also may want to have some diversity in the timelines. And again, the returns are tied directly to the success of the project. So we do our operations, we do our deals, with 2 different types of syndications. We always start our investments with a 506B. And to invest in a 506B, we must have a previous existing relationship, and you must be considered a sophisticated investor. And that's my role to help you understand about investments so that you feel comfortable enough to invest. And again, there are only 35 non-accredited spots. And so again, we offer them to our massive capital community first so that we can get these 35 spots filled with our friends and family and people that we know through our system. Now, if we're only raising $3 million, it may not reach our 35 investors. But if we're raising 5, 6, 7, $10 million, we definitely would get to the point where we would run out of spots for non-accredited investors. I'm sorry, I touched my computer and it made my sound go out. Am I back on? My sound going good? Okay. So we can't offer our 506B deals on this particular webinar because I don't have a previous existing relationship always with people who show up. And we post these webinars on our YouTube channel. So I can't do that. It's considered general solicitation. And then we switch on, by the way, accredited investors still invest up here. They just don't have to prove that they're accredited. Then we switch our opportunities to a 506C, and only accredited investors can invest. And that means you have $1 million in assets excluding your home, or you have a personal income of 200 or a family income of 300. And again, there are no restrictions on soliciting. So it's the biggest availability for me to market. So for example, this morning or tomorrow morning, we're sending out an email for a new deal that's going to happen. I have about 2,000 people that are considered established relationships. But when I go when I go switch it to a 506C, I have 7,800 people in my database. And so again, what really want to do is I want to make sure that if you're interested in passive investing, I know it. So you don't miss out on these opportunities. So all you need to do is book a call with me, say, listen, I'm interested. Doesn't mean I'm going to invest. It just means I'm interested. I would like to see your opportunities because I'm not an accredited investor. Or even if I am, I would like to invest without having to prove that I'm accredited. When you invest in the 506B stage, you can just self-verify. But when it's a C, you have to use third-party verification. So again, if that's something that's interesting to you, you just tell me. And all we do is we put a tick box on my CRM system. And all we do is we know that, hey, we're going to call you and say we've got a deal coming up so that you don't miss out. And again, that way you're ready when we're ready. And I always recommend that you go to as many deal webinars as possible. When I first started doing this, when I first started investing, I signed up like 3 webinars a day and I watched them in weekends. I did all kinds of things because I wanted to learn what people were saying, what I would be learned, what type of investments were out there. So again, very important. And if you don't find a way to make money while you sleep, you will work till you die. So I know I've talked about this before that I used to play the game of Monopoly as a kid. And I knew the people that bought the houses and converted them to hotels and had the good properties, they won the game. Then I became an adult and I kind of forgot all about that. And I just kept going around the Monopoly board collecting my pay. And guess what? I was paying my brother or my sister or my dad the rent money when I landed on their property, and they won the game. So again, you want to put your money to work for you so that you can make money while you sleep. This is a powerful slide. So remember before we talked about you're going to own 70% of an asset. We're going to use leverage to buy it. But the real secret on commercial real estate investing is the compounding value of your money. So our goal is to normally double your investment every 5 years. So if you put $100,000 into a deal and at the end of 5 years, you receive $200,000. I'm always telling people the most important thing is to keep your money invested, keep it compounding, and you'll see why here. So then you take the 200, you grow it to 4. You take the 4, you grow it to 8. Take the 8, you grow it to 1.6. 1.6, you grow it to 3.2 million in 25 years. Now, I have not included any tax on this, so you will at some point won't be able to keep it all unless you were really smart and converted this to a Roth IRA. Then this would be all grown tax free. But I want to see the power. So a lot of people say, well, I want to invest so I can live off my investments. And you can do that, but I want to make sure you understand. Put in 100, make 100, spend 100, put in 100, make 100. At the end of 25 years, what are you going to have left? You're going to have 200. Yes, we only do commercial, not any residential real estate. Yes. So again, I want to talk a little bit about what happened in 25 and what's building us to come to the future for what's happening. So again, what got us here? If we go back as far as 2021, there was a big race for yield. We were in a low rate environment. Interest rates were crazy low, and there was a huge demand for syndication loans and commercial real estate deals. Many real estate syndicators really utilized aggressive strategies, a high loan to value. So this is very important. Remember, I talked about getting a 70% loan to value. Well, some people were getting a 80% loan to cost. So buying a $10 million property, but it needed $2 million repair, and we were borrowing not $10 million on a $10 million property because we got the 2 million, or actually $9 million on a $10 million property because we got the $2 million from the bank. And this was all working when things were going really, like the cap rates were compressing and things were happening, a lot of things. But then what happened is interest rates went up, everything went crazy, property values started to drop, and anybody who did these really got into trouble. So the banks again started hiking the interest rates. And then there was a massive oversupply. US saw a 50-year high in multifamily. And I've got some slides that are going to talk about that coming up. And again, the flattening rates and concessions. So what happened was all of a sudden now there was an oversupply of apartments. There was a lot of things that were happening. And so what happened was rent started flattening versus growing. And then a lot of new apartments that came online had to offer concessions. So concessions are where I say, hey, if you move into my apartment, I'll give you a free month. I'll do this, I'll do that. And that, of course, reduces how much money you make. There was a massive influx of new supply. And I've got a couple of slides that talk about that coming up here. Where's my? So again, what happened was nobody knew they were swimming naked until the tide went out. So we had a lot of operators that were stretched super, super thin, but it all was fine. We didn't know they were swimming naked. And this is a great, now you see, I do a lot of Warren Buffett quotes. I'm a big Warren Buffett fan. So again, Baron Rothschild said, when there's blood in the streets, even if it's your own blood, it's time to buy real estate. And I actually think we're at the end of a real estate cycle, starting a new cycle. And I actually think this is going to be the next couple of years, I think are going to be a real boom because, again, a lot of things got reset. We're buying properties. We know what the interest rates are. We're not getting variable rate interest rates. There's a lot of things that are happening. It's a good time. So again, some of this will repeat because with this slides here talk a little bit about the syndications and that, but how do busy professionals build wealth by investing in commercial real estate syndications, right? So again, busy professionals typically build wealth with commercial real estate syndications by investing passively as a limited partner alongside experienced sponsors. This part is key, very key. Experienced operators. We're going to talk a little bit more about that, but you want to be investing with people that you know, like, and trust. You want to be investing with people that are offering education, that are offering all kinds of things, that are doing different things, right? So investors focus on selecting the right sponsors and the deals and let the cash flow principal pay down and the appreciation compound over year. The core job of a busy professional is not to operate properties, but to define their goals, vet sponsored, rigorously pick a few well underwritten deals, diversify over several years, and then reinvest distributions. So again, super important that you are able to find people that you know, like, and trust. And that's why you're going to want to go to a lot of webinars. I will never tell you only invest with us. I think you should be investing with a couple of groups. You should get some people that you know that you like. And the reason for that is you want to be able to have some balance in different types of things that you do. There are some asset classes that we don't do that some other folks do very well. And you want to make sure that, especially once you start getting into large numbers of investments. So again, we talked about this, so I'm not going to spend a lot of time, but a real estate syndication pools capital from multiple investors to buy larger properties. You couldn't buy these alone, right? There's no way you could buy a $10 million property by yourself, and you probably wouldn't want to because there's a lot of work that does it. So again, the general sponsors, they operate the deal, and the LPs contribute most of the equity, have limited liability, and receive passive income, profit splits, and tax benefits. Tax benefits are huge. We're not going to talk too much about them here, but there are a lot of ways that you're going to be able to get some serious tax benefits. Who you are and how you get your income will depend on how you can use them. So if you're a real estate professional like me, full time, I can take full advantage of all the tax things. So love him or hate him, when Donald Trump was debating Hillary Clinton, he said he pays no taxes. Why? He was a real estate investor. And why do you think he bought the big beautiful bill back? What put 100 bonus depreciation back? Because he's a real estate investor. So again, what should you be doing? Right. So you're not going to be doing the day-to-day work, finding deals and due diligence, financing, management, renovation, and sale. All of those things are handled by the sponsorship team, not the LP investors. So again, when we come up with a property or come up with a deal, we're going to invite you with a webinar and we're going to lay out our business plan, right? So we're going to say, here's the property we're buying. Here's how we're buying it. Here's the type of debt we're buying it with. Here's our business plan. Now, I want to make sure again that I'm really clear. This is a crystal ball. This is not a hard facts, right? Life happens. You get in there and you find something you didn't know, or you find something even better that you didn't know. We bought an apartment complex and there was two more people living there than they had on the rent roll. That was a nice bonus. We didn't have to fill those units. And again, investors can achieve exposure to institutional scale assets with relatively low minimums per deal. So again, our average minimum is about $50,000. So again, you could put $50,000 towards a $10 million property and you're a fractional owner of that $10 million property. And it's really with low, and we call it $50,000 low minimum. And then you keep your commitment mostly up front by vetting the sponsor and the opportunity. So your real job is to vet this, the sponsor and the opportunity. And then again, you go from zero to being able to grow a portfolio. So again, you want to make sure what's important to you. Now, people always say, well, what type of deals do you like, Trevor? And I say deals that make money. That's it. It's kind of a vague thing. But when I was working full time, I was very focused on wealth creation. When you go back to my chart, I wanted to make my 100 into 200 into 400 into 800. That's what I was focused on because I had money coming in. I had a job coming, to paying my bills and doing different things. But some people say, well, they may need to have some of the cash flow. And again, even though I've said don't live on the cash flow, you got to eat, you got to pay your bills, you got to be able to do different things. So again, you want to make sure that you're looking at it. So you're going to look at some deals versus a high upside with value add opportunities. I've always talked about it. I invested in a medical center and it came with just a 10% payment, but it was like clockwork. I got a check every quarter on my investment. And I was always bragging that this is really good, but I'm going to be honest. It sold and all I got was my money back because there was no upside. It was a little disappointing, but at the end of the day, I'm still good with that because you're looking at your whole portfolio. So I owned it for 3 years. It paid the money, was supposed to sell in two. It sold early. That's okay. And the sponsor's a friend of mine. They said, oh, we did really good on this deal. And again, I think it's great because again, I knew what I was doing, right? So again, the typical hold period you're comfortable with. So we do have some deals that are 3, some that are 5. We don't have any that are 10, but some that might be 7. But you want to know how liquid, because again, and when you invest in a 5-year deal, you're really not going to get your big payday to the end. You usually make about 30% of those proceeds over the 5 years you own it, and then you'll make about 70% of the profits on the sale. That's normally typically what happens in these type of deals. Now, again, we have some development deals. They're 3 years. Now they have no cash flow because we're building them and then we're selling them. Then multifamily will have some cash flow. Sometimes it will build up. Sometimes it will be different. But you want to make sure you're balanced out. Also, one thing you want to make sure that you're doing is you don't have everything coming due at the same time because there may not be another opportunity and your money could sit idle for 3, 4, 5, 6 months sitting there earning nothing because banks aren't paying anything on it. So you want to be able to keep your money moving. You never want to be under duress saying, well, I've got to get this money back out there. I'm not really sure about that deal, but I've been waiting for 3 months. Just want to make sure you balance things out, right? So again, learn the basics in your role. So the key roles of the general partners are the active versus the LP. So get familiar with the common structures. So how are we doing it? We're doing a new LLC. There's LP units, there's preferred returns, there's profit waterfalls. Where does the sponsor participate and offer offer a baseline before they receive? So all of our deals have a similar structure, but they're not exactly the same. So for example, most of our deals are pretty simple. It's a 70-30 split with a 7% preferred return. So again, what does that mean? Until you make 7%, we don't get our 30%. But we do have some deals, especially our new development deals, where we've said, hey, listen, these are going to have a pretty high internal rate of return. And so what we do is we say it's a 7% preferred, it's a 70-30 split up to 17% IRR. But if we achieve greater than that, we get a 50% split. And again, you just need to understand it. And the way I like to explain that one is we pay you first, we pay you more if we don't do what we expected to do, and we both get paid more if we do what we expected to do. But you want to make sure that you understand that, right? You don't want to all of a sudden have a surprise and go, well, wait a minute. I thought it was a 70-30 deal. Why are you guys taking half of the profits? And because it can be substantial. And again, you just want to make sure that you understand what are the rules, what are the waterfalls, all the different things here, right? So again, build a short list of strong sponsors. At the beginning, it'll be pretty hard to find them, right? So you're going to look for sponsors with good track record, conservative underwriting, clear communication. And I'm here to tell you, nobody ever does a webinar and say, listen, man, this is an average property with wild expectations, and we're going to triple your money. They just, I mean, some of them say they're going to triple your money, but nobody says that. Everybody says we have conservative owners. So you got to make sure that you're with people that you really believe that they do those kind of things. And there's one more thing I'd like to say here. I had a theory. I was looking for an average of a 17% IRR. I was looking for an average of a 2x my money. Anybody who sent me a deal that said, I'm going to give you 3x your money, I just hit the delete button. My mama told me if it's too good to be true, it probably is. I've lived that my whole life. I just don't want to take that risk, right? And now maybe the deal will triple my money. Because again, you got to remember, these are just projections. I know I've bragged before. My best deal I ever invested in, one of my, I think it was about my fourth or fifth investment, they tripled my money in 20 months. Their plan was to double it in 5, and they tripled it in 20 months. Well, how did they do that? They solved it right before the world went crazy. People were paying crazy amounts of money for properties. I got lucky, right? So it's what it is. So again, you want to make sure that you're looking at that. So again, some metrics, cash on cash, that's going to give you an idea of how much cash gets put out during the time of the property. My favorite is IRR. That's my favorite metric. It's an internal rate of return. And it basically, a dollar earned today is worth more than a dollar earned tomorrow on IRR. Because again, I want to keep that money moving. I'd rather have a hamburger today than maybe 2 hamburgers tomorrow for any of you Wimpy fans. You want to make sure that you're understanding what they are. So my 2 big ones are IRR and equity multiple. And again, equity multiple without IRR. So if I tell you I'm going to double your money, but it takes me 10 years to do it, that's about a 10% IRR. If I take 5 years to do it, that's about a 17% IRR. If I take 3 years to do it, that's about a 22% IRR. So again, you got to be sure that you get an idea. Now, can a 3-year deal turn into a 4? Yes. Can a 5-year deal turn into a 4 or 6? Yes. So again, you just want to make sure. And you also just want to look at the rent growth. So for a while, rents were growing crazy. But you want to make sure that they're doing conservative rent growth, right? They're looking at the area. You want to make sure. And then you want to examine the break-even occupancy. So we presented a deal and we break even at 70% occupied. You want to make sure that we have some CapEx reserves and budgets, the market fundamentals and clarity of the business plan. So again, some simple things you can do you can see, okay, listen, the rents are this much and they want to put the rents up to, so they want to take the rents from $1,500 to $2,000. You can go on do a city search and find out the people that live in a 5 mile radius of that apartment can't afford a $2,000 apartment, right? They only make $28,000, $35,000 a year. So you want to make sure you're looking at things like the crime rate, the income rate of the area. And again, most sponsors will give you this information, right? So the deal we closed in North Carolina, the average income in that particular area was about $100,000. The deal we closed in Alvin, Texas, the average income was $42,000. All right, huge difference. But you want to make sure you disclose these things. Now, again, it doesn't mean that people in that area, that was just an average in that microcosm of the area, right? There's lots of people in the oil industry around Alvin that are making a lot more money. So again, you just want to make sure that you're understanding the market fundamentals and the different things. Very important to understand those things. So again, once you're done, once you feel comfortable, you'll normally be asked to make a commitment, right? So you'll go onto a portal. So you'll log on to our Massive Capital portal. You'll create an account. And again, you can invest as an individual. You can invest as an LLC. You can invest with your self-directed retirement funds. So you would create an account and you can have multiple accounts and you'll create an account with all of that information. And then you'll say, okay, I want to make a soft commit, and you'll go through everything and then it will pre-populate this. There's basically about 120 pages in a PPM, and it's 120 pages of how I can lose your money and it's not my fault. Okay, it lays out all of the risk. It's kind of a daunting document. And then there's an operating agreement. And again, you don't need to become a lawyer to do it, but you want to make sure some of the basic parameters, right? What happens if we run out of money? How are the partners going to take care of that? What happens here? Who makes what decisions? Who's in charge? So all of these things will come into a subscription agreement. It's all electronic. So once you do it, you'll digitally sign everything, and then we countersign it, and then you wire the funds to fund your investment. Now, again, if it's a 506B, all of this paperwork has to be done and you have to be funded before the 506B closes because you're not an accredited investor and you don't have to do it. Once you're an accredited investor, you'll have, and we upload a whole new PPM to the site. So there's going to be another one. Oh, thank you. I'm glad you were here. The replays plays on our YouTube channel. Thank you. So again, that's how you'll do it. So again, how do you build wealth over time? Cash flow, regular distributions from net operating income provide passive income that can be reinvested in additional syndications, increasing the exposure over time. You can get growth equity. So again, some deals, there's a lot of cash that comes in, again, most of them I invested in were wanted to grow my net worth. And again, you want to make sure you understand the business plan, rent increases, expenses, optimization, renovations, the property value, investor equity typically increases, and they realize that the finance of the sale. So one of the things I want to make sure I talk about a little bit here, how we add value in commercial real estate is very different than how you add value in the single family market. So if you buy a $200,000 home in a neighborhood and you decide you're going to go crazy because your wife wants it, and you put $100,000 of upgrades into your home, chances are your home's not worth $300,000, because what they're going to do is they're going to look at all the homes in the neighborhood and there's going to be a range, right? They're going to look at comps and there's going to be a range. And you're not going to get $300,000 for that home just because you did all these repairs and all these things that you wanted to do. So again, you're going to look at that. But where multifamily is very different, it's a business. And so it takes the net operating income. So when you grow the net operating income, it sells for a multiple of it. One other thing I want to share here that's super valuable for you to understand. If you own a single family home and you increase the rent by $100 a month, does that increase the value of your home? It does not. It may increase your cash flow, but it doesn't increase the value of an apartment or of the asset you own. So let me tell you, we have a 200 unit property in San Antonio. And if we can take all 200 units and we can increase the rent $100 a month, that creates $4 million worth of value to that property. Think of that. $4 million of value by pulling one lever of being able to increase the apartment rents $100. And that assumes that we don't increase our expenses $80, right? Which we wouldn't really need to. It doesn't cost us any more to be able to operate them when they're full. So again, you want to make sure that we do that. And then obviously you want to make sure that you understand taxes and how to pay as little taxes as possible. It's not always how much you earn, it's how much you keep. And real estate is one of the most tax efficient ways to be able to invest. So again, busy professionals considering commercial real estate syndications, what steps do you need to take, right? So the best time to plant a tree was 20 years ago, and the second best time to plant a tree is now. So again, when we looked at my compounding thing, if I'd have started, I started at 58. If I'd have started at 25, do you think I'd be in a slightly different financial position? I mean, how many people now, if you understood 25 years ago that I could be a multi-millionaire, would change what they're doing, right? I think a lot of people would do it. So this is one thing that's super, super interesting. So this is the housing affordability gap. This is nationwide. So this is all of America. And you can see this bottom line. This is what's happened to rent. So you can see rents jumped up really good in 21, 22, 23, kind of leveled out. So the average rent right now in America is $1,880. But check this out on housing. What happened here? Look at this. Because houses went up massively in value, they dropped a little bit, and interest rates were crazy high. So what happened is it's $3,066 now is the average mortgage compared to the average rent. So this delta is almost $1,200, forcing a lot of people to stay as renters, which is really good for us as apartment buyers. Another thing to look at here, this is a 10-year average. This is scary, actually. It's kind of sad. 48% of Americans qualified for a mortgage. Now only 28% of Americans qualify for a mortgage. So what does this mean for us that buy apartment complexes? There's 70% of the market that will never be able to buy a house. Never's a long word. Let's hope that things catch up and people be able to do it. It's much better if it stays up here in the 30, 40, 50 mark. So again, this is another very interesting statistic. So back in 2010, the average first-time home buyer was 30. Then in 10 years, it went up to 33. In 2 years, it went up to 36. In 3 years, it went up to 40. So 40-year-olds are either living with mom and dad or living in an apartment, right? Those are the only two options if you cannot get a house to buy. So this is another one here. This is talks just about apartment vacancies, right? So you can see there was a big dip here in vacancies, right? There was a lot of like it was crazy. You could hardly get an apartment, and then all of a sudden they started building tons of apartments. And so what happened is the occupancy started to go down, right? So the vacancy rate up here was 8% because there was almost no supply being added to the marketplace. Then lots of supply came in and vacancies went up. And again, this is nationwide. There are some cities that are worse than this and some cities that are better than this. Again, in short look, what do you want to do? You want to look for stable growth markets and population and rent growth, but not aggressive like we saw before. You want to look at deals with fixed rate debt as a reasonable loan to value of 60 to 70, not the 80% in the past. You always want to take care of a 100% bonus depreciation. Also want to make sure that you understand if you can't use it, you don't lose it. So if you get the bonus depreciation, it will stay with you until you can use it. So you can use it at different times. And again, look for experienced operators who are focused on risk mitigation, deal structuring, targeting markets with better supply and demand. The distress has created one of the biggest buying opportunities. The best time to buy real estate, you win their blood in the street, even if some is yours. Don't wait to buy real estate and wait. You still have some time. The next cycle is above us, right? So again, I'm not going to go through this too long because we're wrapping up near the end. But again, this very much goes through that pricing is clearly reset. So again, this property I mentioned that we closed in North Carolina, that property was for sale for $7.8 million, and we bought it for $7 million. We waited 1 year to buy it. We made an offer of $7 million the beginning of last year. They said no. We made an offer of $7 million in the beginning of spring. They said no. We made an offer and they finally said yes, because they were in a time when they needed to sell, right? So these businesses go through cycles, and the current owner, it was time for him. He actually had a property he'd found that was a larger property, and he was selling two of his smaller properties to be able to buy a larger property. So again, it's super. There's a lot of backdated loans that are coming to maturity. So there are a lot of good deals with bad debt. And so that's going to also create a very big buying opportunity. I'm not going to go through these ones here. So this is another, oh, that was the same slide I showed before. Capital's not leaving. It was just waiting for some more discipline. There's a very new supplies being choked off, right? So you check this out. So this was new multifamily starts. So you can see here, there was a pretty big building boom here back in 2014, 15. Then it leveled out. And then check this out. This is multifamily starts. In 2022, it was at an all-time high of 156,000. This has now dropped 76% to 37,000 new multifamily starts. Another thing you need to know about this is when multifamily starts, if you get an apartment complex and you start getting it approved here in 25, you're probably not even getting up and operational till 27, 28. So this is going to be a slow. This will come back, but again, it's definitely very good for us. It's rebalancing the marketplace. Again, apartments under construction, 1.1 million, down to 53%, down to 520,000. This is very good because this again is going to take a long time to build back up. Never have we seen a spike like that, right? You look at all these years, there's one spike here, there's a couple of spikes and a couple of here, and then whammo, that's a huge spike. It's really, really crazy. So inflation is starting to fall, rates have starting to fall. So again, this is where you can see this is the interest rates, right? So again, everybody was buying almost free money. And then of course the feds went crazy, kept going crazy, got a little bit of common sense. We're going to see what happens. They've definitely come down a bit. They're at about 4.1. They're forecasted to go down to 375, 350. So will be interesting to see what will happen. And this will also take some pressure off the single family market where we talked about, so hopefully it will reach back up to where 40, 50% of Americans can afford to buy a house. This is a cap rate trend. So again, cap rates are up. So to make sure that you understand, the lower the cap rate, the higher you make when you're a seller. When it comes up here as a seller, you're making less money. So what's happened is people that bought here, these are the folks that are now having to sell here, and it's killing their numbers. It's killing their returns. So again, cap rate is very good. The best deals, distress is the operator level, not at the asset level. Super important. The buyer field is thinned and a lot more disciplined capital. So I remember in the heyday, I was talking to somebody today, I made an offer on a property in San Antonio, and I was number 18 in the hierarchy of 25 offers on a property. That's insane. And 4 people went to best and final, and they were significantly better than we were doing. So again, there's a lot more, it's coming down. There's a lot of things that are happening that are really making it. The sentiment is still poor, which usually means, what do you want to do? Remember what Warren Buffett said, one more quote from him, when others are greedy, be fearful. When others are fearful, be greedy. So again, very good time for us to be getting greedy. And again, the cycle has quietly been again to reset. So 3 reasons to begin investing. You get a full year passive income working for you, right? The earlier you invest, obviously, the quicker you start growing money. You're going to start your 26 tax strategy off right. So by deploying your capital early, gives you more time to capture depreciation benefits, maximize passive losses, strategically plan all year long for your tax positioning. Said it before, it's not how much you make, it's how much you keep. And again, secure strong deals before the competition heats up. So again, there's a lot of people sitting on the sidelines waiting. And Q1 is historically when serious investors move long before capital floods the market later in the year. Getting in early means you get access to better opportunities, avoid being oversubscribed offerings, and lock in favorable terms before demand does. So again, you were one decision away from a new life. I hope I can help you start your real estate investing journey, create that new life. And again, massive dreams need massive actions. These are my partners at Massive. So this is Sanjay. He's who I invested with for the first time 7.5 years ago almost. Mike and I have been friends for about 6 years, and Shirar, I think 5 years. So I'm doing it. So again, my goal is to help 100,000 people reach financial independence through real estate investing. I hope that you learned something tonight. I'm going to stop sharing. We got a small group tonight. It's nice to see you, Natasha. She's always there. There she is.
Hi, how are you? And I
Good.
actually put a question in the chat just asking if you could repeat what you said about the IRR per year.
Yes. So well, it's not per year. It's IRR is a total earned over a period of time. So IRR is always shown in the length of the deal. Let me pull up a slide that will give you some good on another presentation I have. Look that up. Anybody else has any questions while I'm pulling that up?
Because I
Where
liked
where
how,
are you now, Natasha? Are you back in Houston?
yes, I'm back in Houston. I just went to Dallas to meet with a group and I'm back in Houston finally.
Awesome. Everything
Yes,
going good? You have a good New Year's?
yes. What about you?
Yeah, it was good.
Okay, it's always nice to start off the year, the good new year.
It is. Just trying to see if I can find that slide that I had.
And I like what you were saying about, I think you said if it's whatever percent, it's 5 years,
Yeah,
whatever percent, that part of the IRR.
let me just see if I can find it here. I got so many slides and a presentation. Okay, all right. So this will be a really good lesson here. So these are all the different types of returns. I'm glad I found the right slide. So we can see that good is up there, oh, almost. I can see it's black. There we go. So again, internal rate of return is the time value of money. IRR is unique because it factors in timing and the magnitude of all cash flows. A dollar received sooner is worth more than a dollar received later. Then there's equity multiple. This one's pretty simple, right? I 2x your money, which means I double your money. Cash on cash is basically your cash flow. Preferred return is where you're going to get the 7% preferred return. It's basically where you get paid first and we don't get paid. And ARR, I don't use that one very often, but ARR, it basically just takes everything and divides it by how many years we think the deal's going to happen. So let me see if it was changed to the next slide. It's thinking, oh, come on. It's spinning there, it's spinning that. So again, timing of cash flow, earlier cash flow, higher IRR. Sometimes you can have a cash out refinance. It used to happen a lot before. So if you get a portion of your money back early, that's really going to impact the IRR. Make it, because again, any cash sooner is worth more than cash later. So here's an interesting example. So if you invested $100,000 and you made 40,000 back in year one, 50 in year two, 60 in year three, that works out to a 21.6. You invested $100,000, but the deal did really good and gave you 60 in the first year, 50 in the next year, and 40, that comes up to a 25% IRR. So again, you can see getting your cash early makes this number higher. You're not making more money, you're just making it quicker. So again, this has low cash flow. You put in 100,000 in, you get 20, 50, and then 80. It drops down to about an 18% IRR. Now, let's say you had a deal and you put $100,000, but there was no cash flow at all till year three. See how that goes down to 14.5. So all of these deals have made the same equity multiple, the 1.5. This one's 1.5 because this is a 3-year example. But you can see the big difference, right? This one here is better because you got 60 back that you can reinvest and keep growing again. Does that make sense?
That does. And how do you end up in the deal that has the 60,000. Is that one where they
Well, it just
say,
depends. There's very few of them out there. I'm not going to lie.
okay, okay.
Yeah, there's very few of them out there right now that have that kind of returns on them. There really are not that many.
And would that be more so close to something that they say that's already cash flowing?
So the better cash flowing deals help with the cash return. But again, they're not producing the kind of cash flow to dramatically increase the IRR, but it
Okay.
will definitely increase it. So again, if you have a deal that's producing about 10% cash on cash right from day one, it will produce a higher IRR than one that's producing five and then it grows to six and then it grows to eight, then it grows to 10 and then it grows to 12. Your IRR will be higher.
Okay, that makes sense.
Awesome. Thank you. Good question.
Thank you.
Happy New Year to you.
Happy New Year to you too.
I'll be in Houston the third Thursday in February.
Okay, I'll have to make sure to be in town.
Yeah, we're gonna do a property tour and then there's a big dog meetup that night.
Oh, yes, that should be good.
Awesome. Any other questions before we give you back your evening? Awesome. Well, I really appreciate everybody coming. Please feel free to book a call if you want to talk to me about anything. Really appreciate it. Good to see everybody.
Thank you.
Thank you. Thank you.
Thank you. Good night.